Usually when we sit down to prep for these deep dives, we are looking for a thread, a subtle theme, or maybe a sector rotation. But looking at the stack of research for this week, the sheer velocity of money moving around uh, it's honestly making my head spin.
It really is frantic. It feels less like a normal market cycle and more like a complete seismic shift.
Exactly. We aren't just talking about stock ticks or your standard quarterly earnings beats. We are talking about massive tectonic strategic pivots. It feels like everyone from media moguls to mining giants just decided to make their all-in mood at the exact same time.
I think that's the right way to frame it. If you look at the sources we have today, it's a chaotic mix on the surface. We have hostile takeover bids in Hollywood.
Hmm?
We have this massive reality check hitting the AI sector, finally separating the pretenders from the contenders. And then almost as a counterweight, we have this very tangible physical rush for resources, specifically copper.
It's like the board game Risk meets Monopoly, but with robots involved. We have a stack of sources here covering everything from a corporate soap opera involving Warner Bros., Discovery, and Netflix, to a massive repricing in software, and even a geopolitical tour that includes robots dancing on TV in China.
And believe it or not, a massive recall of peanut butter.
I could never forget the peanut butter. But seriously, the mission for this deep dive is to find the signal in all this noise. Because when you have billions of dollars shifting hands in shipping, media, and tech all in one week, there has to be a pattern there.
There is. It's a search for equilibrium. Everyone's trying to find where they stand in a market that is rapidly changing its definition of what value actually looks like.
Right. So let's start with the drama. And I mean legitimate high-stakes drama. We have to talk about the Warner Bros. Discovery saga.
This is a fascinating case study in leverage and, honestly, desperation.
Yeah.
So the situation is that Warner Bros. Discovery, let's just call them WBD, has reopened talks with Paramount Skydance.
Okay, but here's the twist in the research that I found absolutely wild. To even talk to Skydance, WBD had to go to Netflix and essentially get a permission slip.
That's right. They needed a 7-day waiver from Netflix.
That sounds like asking your current partner if you can go on a date with your ex just to catch up. Why does Netflix hold the keys here? What sort of leverage do they have over WBD?
It comes down to exclusivity clauses in previous negotiation agreements. WBD has a shareholder vote on a deal with Netflix coming up very soon, March 20. When you are that deep in the process with a merger partner, you're usually legally barred from shopping around or entertaining other offers.
Right.
So the fact that Netflix granted this waiver is highly significant.
Why would they do that, though? If I'm Netflix, why let WBD flirt with Skydance?
Two possibilities. One, Netflix is supremely confident that the Skydance deal is smoke and mirrors and just won't happen. Or two, they're playing a longer game where they want to see the true market value of the asset established before they close their own deal. Because look at the numbers. There was a hostile bid floating around at $30 a share. Now, Paramount Skydance is indicating they might go to $31 a share if negotiations restart.
So WBD is squeezed. They have this Netflix deal on the table. The clock is ticking toward that March 20 shareholder vote. And now they have to see if the grass is greener and richer over at Skydance within a 7-day window.
Precisely. It shows just how fragile the media landscape is right now. Everyone knows consolidation is necessary, streaming is expensive, and audience fragmentation is incredibly real. But figuring out who owns whom is a messy, litigious process. That extra dollar per share represents hundreds of millions in value, so fiduciary duty kicks in. They literally have to explore it.
Speaking of consolidation, it's not just media moguls making moves. We saw a massive deal in shipping this week, too. Hapag-Lloyd buying Zim.
Yeah, that's right. Hapag-Lloyd, the German shipping giant, agreed to buy Zim Integrated Shipping for about $4.2 billion. And the market reacted immediately. Zim shares shot up in pre-market trading.
I feel like shipping is one of those industries you kind of forget about once the pandemic supply chain crisis ended. Why does this matter to the listener who is trying to track broader market trends?
It connects to the broader theme of logistics normalization. During the pandemic, shipping was the golden goose. Rates were sky high because everyone needed to move goods and capacity was choked. Now, rates have crashed back to earth. When margins get compressed like that, the big players swallow the smaller ones to maintain efficiency and, crucially, pricing power.
So less competition in shipping generally means prices stabilize or maybe even inch up for the companies moving the goods.
Exactly. It's a classic, mature market move to defend margins. And just to round out the billions being spent category, we have Danaher closing in on Massimo.
This is a huge number, a potential $10 billion deal.
Yes, and for Danaher, this would be their biggest acquisition in over 5 years. Masimo is a medical tech firm, largely known for non-invasive monitoring.
Right, the pulse oximeters and things like that.
Correct. This signals that while everyone's looking at AI, the healthcare and life sciences sectors are quietly making massive consolidation plays too. They are betting on an aging population and the need for better health data, completely regardless of what the tech sector is doing.
Okay, so the chessboard is moving in media, shipping, and healthcare. But let's pivot to the topic that sucks all the oxygen out of the room: AI. Because looking at the notes this week, the narrative seems to have shifted. It feels less like a party and more like, well, a hangover.
I wouldn't say a hangover, but definitely a sobering up. We are seeing what analysts are calling the great repricing.
That sounds ominous. What does repricing actually mean in this context?
It's a necessary correction. Basically, there is a $2 trillion with a T reset happening in software market caps. For the last year, if you had AI in your pitch deck, your stock went up, investors threw money at anything that sounded like an algorithm.
Yeah, it was a frenzy.
Now that phase is over. Investors are frantically trying to figure out who the actual winners are versus the companies just riding the hype. The sources mentioned a tech-led futures slip specifically because of this anxiety. The market is suddenly asking to see the revenue and the profit, not just the promise.
So we're moving from the promise phase to the proof phase, and that question leads everyone to one company, the kingpin, NVIDIA.
It always comes back to NVIDIA. Their earnings are coming up on February 25, just next week, and the sentiment in the research is completely split.
It feels like a battleground. You have the bulls saying the spending isn't stopping, just look at the CapEx budgets, and you have the bears waving red flags saying this is a bubble and the growth can't be infinite.
It is incredibly high stakes. The entire market is essentially holding its breath for that one report.
But there was one detail in our research regarding NVIDIA that I thought was fascinating, and it wasn't about chips or teraflops, it was about estate planning.
Ah, the step-up basis rule.
Yeah. It's such a specific financial nerd detail, but the implications are huge. Break that down for us.
It is huge, and it's actively driving behavior. The AP ran a piece using NVIDIA as the prime example.
Okay.
Here is the scenario. You bought NVIDIA years ago. Maybe you put in $10,000, and now it's worth millions.
The absolute dream scenario.
Right, the dream scenario until you sell. If you sell now, you pay massive capital gains taxes on that profit, potentially 20% or more depending on your bracket. However, under current U.S. tax law, if you hold that stock until you die and pass it to your heirs, the cost basis of the stock steps up to the current market value.
So if I bought it at $10 and it's worth $800 when I die, my kids inherit it at a cost basis of $800.
Exactly. The capital gains tax liability for that massive appreciation effectively vanishes.
So NVIDIA isn't just powering chatbots, it's becoming a vehicle for generational wealth transfer. That locks up a lot of stock, doesn't it? People are incentivized not to sell.
It really highlights how deeply embedded these tech valuations have become in the broader economy, even down to personal finance strategies for the wealthy. It creates a lock-in effect where huge amounts of capital are stuck in this one stock because selling is just too expensive tax-wise.
Wow. But moving back to the corporate side, let's look at who is actually buying these chips.
Yeah.
Because the numbers are staggering. The hyperscalers.
Yes. Amazon, Google, Microsoft, Meta. The research says they are projected to spend over $700 billion on AI capital expenditures by 2026.
$700 billion. That is so hard to wrap your head around. That's larger than the GDP of most countries.
It's an arms race. And the clear beneficiary right now isn't necessarily the software companies making the apps, it's the manufacturers. Taiwan Semiconductor TSM is seeing robust demand for advanced nodes because billions are flowing into accelerators and CPUs.
So if you're selling the picks and shovels, business is good. But what about the smart money? We saw Bill Ackman and Pershing Square making some interesting moves that seem to contradict the whole bubble narrative.
This was a very telling strategic pivot. Ackman exited Hilton, which is a classic hospitality post-COVID travel play, and built a roughly $2 billion position in Meta, along with huge stakes in Amazon.
Wait, I thought the narrative was that Meta was burning too much cash on AI. Zuckerberg is famously spending billions on GPUs.
That's the nuance Ackman sees. His thesis is that Meta's advertising business is deeply discounted right now. He believes the market is punishing them for the AI spending, but he sees that spending as the engine that will drive major margin expansion.
So he thinks the AI isn't a vanity project. He thinks it's going to make their ad targeting deadlier and more efficient.
Exactly. He's betting that AI makes their ads more effective, which increases the value of their inventory. He's not buying the hype of a chatbot. He's buying the infrastructure that monetizes the user base. It's a bet on efficiency.
That's a key distinction. He's doubling down on infrastructure and ad tech, which actually brings us to the next segment perfectly, because you can't have AI, you can't have data centers, and you can't have EVs without stuff, physical stuff.
The transition from the digital cloud to the dirt.
Yeah. We have to talk about BHP and copper.
This is one of those connect-the-dots moments I love in these deep dives. BHP Group reported their first half, EBITDA, was $15.5 billion.
Yeah.
But the kicker, copper contributed 51% of that.
More than half their earnings are coming from copper. Not iron ore, not coal, copper.
And they raised their guidance for 2026 to nearly 2.0 million tons. Why? Because the digital age has a physical plumbing system, and that plumbing is made of copper. You need it for the grid, you need it for EVs, and you desperately need it for these massive AI data centers.
It's ironic, isn't it? We talk about the cloud like it's this ethereal thing, but it's actually just millions of tons of copper wire and silicon chips sitting in a warehouse somewhere.
It really brings us back to reality. And speaking of reality versus the future, did you see the reports coming out of China regarding the Spring Festival Gala?
The robots.
Yes.
It wasn't just a variety show. No, it looked like a sci-fi movie. You had humanoid robots from companies like Bilibili and Kuaishou literally starring in the CCTV performance.
Visuals matter immensely in geopolitics. This underscores Beijing's massive push into humanoid robotics. It's a state-level signal that they intend to lead in this hardware. They want to show the world they're moving beyond just manufacturing cheap goods to creating advanced autonomous agents.
And that geopolitical competition is spilling over into the auto industry, too. We saw a really interesting tension with Ford this week.
This is a delicate situation. Ford is reportedly discussing allowing Chinese EV partnerships in the U.S.
Which seems highly controversial given the current trade climate.
Extremely controversial. GM immediately signaled opposition, and you had dealers, specifically Lithium Motors, citing franchise hurdles to selling new Chinese brands. But the core tension is this. U.S. automakers know they need the battery technology and the cost efficiency that China has already mastered if they want to make affordable EVs.
Right, because Chinese batteries are currently cheaper and more efficient.
Exactly. But politically, opening the door to Chinese tech is a minefield. So Ford is stuck between trying to build a profitable electric car, which is a business necessity, and navigating a trade war, which is a national interest issue.
We are just looking at the facts here, but it really highlights how business strategy is no longer just about having the best product. It's about whose flag is on the factory. Speaking of navigating minefields, let's move to corporate governance, because we had some serious leadership shakeups this week that touch on social responsibility and reputation management.
The biggest headline here is likely Hyatt.
Right. Tom Pritzker stepping down.
He was the executive chairman. He stepped down and announced he won't seek re-election to the board. The context here, according to the sources we are looking at, is the release of DOJ files showing continued contact with Jeffrey Epstein.
And they've already named a successor, CEO Mark Hoplamazian.
Yes. We have to be precise here. The reports state the resignation comes amid these revelations. We aren't speculating beyond what the sources provide, but reading between the lines, it highlights how reputational risk is now a boardroom-level crisis.
It feels like the tolerance window has just completely closed.
It has. Boards are acting much faster to distance themselves from anything that could be toxic to the brand. In the era of social media, a scandal doesn't just stay in the papers. It affects the stock price immediately. Investors are factoring in headline risk as a tangible liability.
And speaking of social media and liabilities, we had Adam Mosseri, the head of Instagram, testifying in California this week.
This was a fascinating exchange on semantics. He was asked about addiction regarding teenagers and app usage.
And he strongly pushed back on that word.
He did. He admitted that 16 hours of daily use is problematic, but he disputed the clinical label of addiction.
16 hours a day. I mean, let's just pause on that. That's being awake. That's your whole life.
It is. And while he splits hairs on the definition to avoid legal liability, the regulatory heat is rising globally. At the same time, in Europe, the privacy watchdog is investigating Elon Musk's X.
This is about the AI imagery, right?
Yes, specifically sexualized AI imagery, what they call deepfakes. Plus, there are reports that xAI's Grok tool has significant gaps in global enforcement. It's another example of the technology moving much faster than the safety guardrails, and regulators are just scrambling to catch up.
It seems like the theme of accountability is everywhere this week, even spilling into the cruise industry.
Yes, Elliott Management, a very well-known activist investor, took a roughly 10% stake in Norwegian Cruise Line.
When Elliott shows up, they usually want changes. They aren't passive investors holding for a dividend.
They are definitely not passive. They want to push for performance improvements. Norwegian shares actually rose on the news because investors assume Elliott will force efficiency, cutting costs, optimizing routes, maybe even changing management. It's a clear signal that the market thinks the company is undervalued but mismanaged.
So, if you're a fan of Norwegian cruises, you might see some changes on board, or at least in the back office.
Likely both.
Okay, we're coming down the home stretch here. It's time for the kitchen drawer. Those quick, specific hits from our stack of sources that you might have missed but definitely impact the world. Let's start with the Fed and mortgages.
Right. Michelle Bowman.
Thrilling stuff, I know, but tell me why we should care about Michelle Bowman's proposal.
She's the Fed vice chair. She is proposing tweaks to how banks handle mortgage servicing assets.
Break that down. What exactly is a mortgage servicing asset?
Simply put, it's the contractual right to collect your mortgage payments. Even if a bank doesn't own the underlying loan, they make money by processing the payment, handling the escrow, and dealing with you, the customer. Bowman's proposal would make it easier for big banks like JP Morgan and Wells Fargo to hold these assets on their balance sheets.
And the broader impact of that.
It puts pressure on non-banks like Rocket Mortgage. For the last decade, non-banks have really taken over this space. This is a regulatory shift that changes the competitive landscape of who wants to hold your home loan. We might see the big legacy banks getting back into the mortgage game much more heavily because the capital requirements are being relaxed.
Got it. It's a pendulum swing back to the big banks. Next up in the drawer, food safety. This one is actually quite urgent.
This is a major recall. Ventura Foods is recalling single-serve peanut butter and PB&J cups.
These are the ones you get in schools, hospitals, maybe a hotel breakfast buffet.
Exactly, food service channels. Brands tied to Cisco and U.S. Foods, it's across 40 states. The reason is plastic contamination.
Yikes. So if you're listening and you work in a cafeteria or have kids in school, maybe check the inventory on those little cups. And finally, a massive investment in South Dakota.
Smithfield Foods. They're planning a $1.3 billion facility in Sioux Falls.
That is a staggering number for a processing plant.
It is. And they are also redeveloping a downtown site with a $50 million gift. It shows that while we talk endlessly about the coasts and tech and AI, the agricultural industrial base is still deploying massive capital in the heartland. That is real money creating real jobs in the physical economy, completely separate from the AI bubble or media mergers.
So what does this all mean? We've covered a massive spectrum here today, from the theoretical valuation of AI software to the very tangible recall of peanut butter cups in 40 states.
I think the key takeaway for you, the listener, is that the market is currently in a state of intense flux. It is trying to find equilibrium.
In what sense?
Look at all the examples we discussed. Warner Bros. Discovery is trying to find the right merger partner just to survive the streaming wars. Investors are scrambling to price NVIDIA correctly before earnings because the old metrics just don't fit the new growth. Everyone is looking for stable footing.
It feels like the ground is shifting under everyone's feet at once.
It is. The old valuations don't make sense anymore, but the new ones, the AI world, haven't fully set. We are in the messy middle.
And here's a thought to leave you with. As we see robots dancing on TV in China and AI generating controversial images in Europe and companies spending $700 billion on chips, ask yourself this. Are these corporate strategies actually accounting for the human element? Or are we just becoming data points in their CapEx projections? Something to think about as you watch the markets this week.
That is the multi-billion-dollar question.
Thanks for diving in with us. Stay curious, and we'll catch you on the next deep dive.